Investing has never been easier with the introduction of Robo Advisors like WealthSimple, Betterment, and SoFi. But are Robo Advisors actually worth it? Advisors, either regular or Robo Advisors, usually charge a percentage to manage your money. Usually it's about 1%. And while that may seem like a small amount, over decades, that can amount to almost 1/3 of your earnings. So we have to really think about it. Is it worth it? And while actual advisors might charge a percentage of your fees, robo-advisors are even worse because they usually pick a portfolio based on a survey that they'll send you. And they'll ask you questions thinking that they can design the perfect portfolio for you, but it doesn't even fully educate you. It doesn't fully determine what is your actual risk tolerance. Are you okay with your stock prices with your portfolio going up 30% one year, going down 30% another year? And oftentimes these portfolios have more bonds than they should have, making them way too conservative, which will often limit losses and make it look good, but in the long run, it also limits your opportunities for growth. And again, these portfolios don't take into account your age, your income, your goals, so that makes these portfolios very ineffective. Now, the only plus side to robo-advisors is how easy it is to get started. It's literally as easy as downloading an app, connecting your bank account to it, and starting to deposit money on a daily, weekly, or monthly basis. In fact, it's actually how I got started in investing. I opened up an account on Wealth, started putting money into there regularly, and starting to learn about the stock market. I started investing in 2015, and since then I've slowly learned more and more every year. So let's take a look at a growth portfolio. So this would be one that's really focused on growing your money in a fund like WealthSimple. And if you started investing recently over the past few years, you're probably looking at your account and thinking, why is my account really flat? I've barely seen any growth. It might even be negative. And we'll get into why that is. So this growth portfolio, it's going to consist usually of 80% equities and 20% fixed income. And of that, only 25% is actually going to be in US stocks, which is actually outrageous because that's where all your growth is coming from. The strongest economy, the strongest growth, and the strongest stock market is the US stock market. And if you've only got 25% exposure there, you're really limiting your growth potential. That 25%, it should be closer to like 50% at a minimum. Second, there's going to be a heavy allocation to bonds. Now, this doesn't make sense to me because robo-advisors, they're going to put 20% into bonds, even if you're really aggressive and looking for the highest amount of growth, which doesn't make sense. Let's say you were in your 20s or 30s, you've got decades of time to continue investing. And even if the market crashed, you've got so much time to make up for that. So you should ideally be more heavily invested in equities, not 20% in fixed income. I would say maximum 5%, depending on your risk tolerance. For someone like me who has a really high risk tolerance, I'm actually 0% in bonds. And so the main reason that your portfolio is going to be fairly flat over the past few years is bond prices have crashed as interest rates have risen. Essentially, bond prices are inversely correlated with interest rates. So as interest rates go up, bond prices go down. So imagine that 20%, which consists of bonds, has basically crashed. And to offset that, you've got equities, but the only real growth that you're seeing in equities is within the US. So essentially, if you're not invested in the US and you've only got that 25% exposure, you're really limiting yourself. And so given all those ups and downs, you're probably basically flat in your portfolio. So I hope that explains more of why advisors, whether robo or regular, are just terrible. You're either paying too much in fees or you're limiting your growth potential. And that's why most people should invest on their own. And today it's easier than ever. Like before, it used to be as easy as a robo-advisor, and now it's even easier with how mainstream ETFs have become. One of the easiest things that you can do is set up a brokerage account, whether it's with someone like Interactive Brokers or E-Trade or Fidelity. And then once you have that set up, you basically go into stocks and search VOO, which is basically going to be the equivalent of buying every stock in the S&P 500. Or if you want to be a little bit more safe, you could even go in and search VTI, which will be every single stock in the US, which is thousands of companies. And buying either one of those will outperform any robo-advisor or money advisor or financial advisor that you could find. And especially if you continue to invest in one of those funds for years and decades, consistently dollar cost averaging in, you will see tremendous long-term growth, and your portfolio could be worth millions, especially if you're starting early, you're putting a significant amount into the market. I don't see why it wouldn't. So forget about robo-advisors, forget about financial advisors. You can do it. You can do this on your own, and it'll be totally worth it. So I hope that helps motivate you. Get out there, start investing, and take control of your financial future now. I hope you enjoyed this video. If you haven't yet liked or subscribed to the channel, please do so. It really helps out. And I will see you on the next one.